you own property in the UK or are thinking of investing, understanding the difference between capital and revenue expenditure is crucial for managing your finances. So, today, let's dive into the key distinctions between these two types of property expenses. So, what is capital expenditure? Capital expenditure refers to the money you spend when you improve or enhance your property. This includes major works like building an extension or renovating the structure. Think of capital expenditure as the cost of significantly upgrading a property. These works add value to your property, and as a result, these costs can't be deducted directly from your rental income for tax purposes. Instead, relief is given when you dispose of a property. At this point, I think it's worth mentioning that as there is often a fair period of time between buying a property, carrying out the renovations, and selling the property, it is vitally important that you keep your own records of capital expenditure, as if you were to move accountants, you will need this information when you come to sell the property to get the relief. Revenue expenditure, on the other hand, covers the day-to-day running costs and upkeep of the property. This includes repairs, general maintenance, and minor improvements to keep the property in good condition. Any replacements, such as a new kitchen or bathroom, needs to be like for like with the modern equivalent. Revenue expenses are costs that do not add long-term value to the property, but are essential to its ongoing use. And importantly, revenue expenses can be deducted from your rental income and reduces your taxable profits in the year they occur. Common examples include repairing a broken boiler, repainting walls, or general property upkeep like cleaning and gardening services. So, if you're a landlord, keeping track of these expenses and claiming them against your rental income can significantly lower your annual tax bill. Let's run through some examples to clarify the difference between capital and revenue expenditure. Capital expenditure. An example of this would be building a new conservatory or converting a loft. These are significant enhancements that increase the property's value. Revenue expenditure, on the other hand, is fixing a leaking roof or replacing a broken window. These are necessary repairs to maintain the property, but they do not increase the property's value. It's easy to confuse capital and revenue expenditure, but getting it wrong can lead to tax issues. For example, replacing a part of a roof would typically be considered revenue expenditure because it's a repair. But if you replace the entire roof and perhaps add some solar panels, HMRC may classify that as a capital expense. Make sure to consult with an accountant or property tax advisor to ensure you're classifying your expenses correctly. This can make a big difference to the profits you make and the tax that you pay. In summary, capital expenditure increases the value of your property, while revenue expenditure is about maintaining the property. Knowing the difference between the two is key to managing your property. Thank you for watching. If you found this video helpful, hit the like button and subscribe for more property investment tips.